Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome. My name is Bryce, and today we're kicking off with a stock on my watch list. We've got another community member for Pimp My Portfolio, and we review 2 investor letters. To get through it, to chat through it, as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We've been loving the response to Pimp My Portfolio, so please keep it coming. But I'm also very excited to hear about this stock on your watch list. Now, before we get into it, especially when we're going to hear about a stock from Bryce, we need to remind everyone.
Especially from me. That's right. Any information on this show is for education and entertainment purposes. Any advice is general, particularly when it comes to stock pitches, stock watch lists, stock ideas, anything stock related.
All right, Bryce. Well, there's no dilly-dallying. I want to hear what you've got to say. Let's get into it.
Stock pitch.
Nice, you got it. All right, Ren, can you fade it out, please? That's it, Ren. Today I am bringing a stock to the table that is on my watch list that came up in my research while I was doing Stock of the Year research.
Oh, okay.
Good work on the buttons there.
Thanks, bro.
Nice fade out. Yeah, so this came up. I did a bottom-up approach for my Stock of the Year. Put in a few figures in the old ticker.
Okay.
To try and filter out some stocks. So I wanted good return on equity. I wanted strong revenue growth. I wanted strong profit growth. I wanted no debt.
So you used the screener on ticker?
Yep.
Yeah. Okay.
Used the screener on ticker. I wanted like a significant, decent market cap. Didn't want a small cap, and came up with a list, which is where I got.
You've forgotten what your Stock of the Year is?
No, it was Booking Holdings. Yeah.
I thought you got that because you were such a big fan of it.
I'm a massive fan of it. I was pleased to see it in the list.
Oh, okay. Fair enough.
So I was like, great, I'm going to do this one. Anyway, the stock that I've got today is called Deckers Outdoor Corp, New York Stock Exchange. The tick is DECK. And unlike...
DECK.
Deck.
Yeah.
Yeah.
So decking.
No. I'm not doing a decking company.
For context, everyone, I came into the office this morning and was like, oh, you're going to be chatting about a decking company. And it just irrationally annoyed you. You're like, no. But it's called Deckers Outdoor Corp.
Yeah.
And its ticker is DECK.
Yes.
Like, give me a break.
Well, look, online it's called Deckers or Deckers Brands. And it's essentially it's an apparel. Well, it's a footwear designer and seller. They sell shoes. Have you heard of UGG?
Yeah.
Yeah.
I thought they were Australian.
So did I. They may be, and UGG bought them, but
Deckers
you
bought
definitely. And Deckers bought them. Yeah, but UGG is their main one of their main brands.
Okay. Wait. How is it Deckers Outdoor Corp?
I know.
UGG is a very indoor shoe.
Well, they also have Hoka.
Oh, yeah.
Their leading like running shoe.
Yeah.
Other brands include Kookaburra, which is a sub-brand of UGG. Teva, Sanuk, they're all the running brands. And then they have a few other smaller brands that I hadn't necessarily heard of, but I'm also not a big brand guy. So they've got a pretty strong stable of brands. But look, what I like about this and why I'm bringing it to the table is just financial performance, essentially, at the end of the day.
Hit me. Give me the numbers.
The last 5 years, the stock price has grown 500%. The last 12 months, it's up 117%.
Wow.
Year to date, up 27%. So it's continuing to perform well from a price point of view. Stock price is 861 with a market cap of 22 billion at the time of recording. But this is a company that just has a strong portfolio of brands that allows it to just continue growing revenue and to continue growing its profit. Its 2 biggest brands, as I said, are UGG and Hoka, and both these brands are expanding and growing very quickly across Europe and Asia. They have strong presence in the US at the moment, but are very focused on European and Asian growth. And their profit has grown 173% over the past 5 years, and they have zero debt. So very strong cash balance position. They have free cash flow, strong free cash flow. So this is, for me, as I said, it was a bottom-up approach, and their financial performance, it's not, blowing the lights out, but it's just consistent and very solid. If you look at some of the metrics in terms of its return on equity, its profit growth, not necessarily market cap, but where it sits relative to other players in the industry, Nike is obviously the number one when it comes to footwear. There's another one called, I think, VP Brands or VF Brands. I can't quite remember what it was, but the financials of Deck are incredibly impressive compared to its peers. The bear case on this, though, is a pure valuation play. It's run incredibly hard. And if you look at where it sits from a PE point of view, I think it has a PE of about 30. If you compare that to Nike, the PE is very similar. I think about 30 as well. But they're both sitting a little bit higher than other peers. So, look, there's nothing too complicated about this business. It's just they have two premium brands in UGG and Hoka, and they are able to, I guess, generate pretty significant margins on that. And this is just a story of how can they grow in markets, particularly UGG, across Europe and Asia. But it's a company that just popped up on the screener. And I think, if you listen to all the experts that come on and think about how they look at companies from an upgrading cycle, strong revenue growth, constantly what's the word? Not outperforming, but exceeding expectations. The stock price is speaking for itself.
Nice.
So
fascinating.
Yeah. It's not a decking company.
No, at least not yet. Yeah. Great. Yeah. Incredible growth. I'm just looking on ticker. So 2018 revenue grew 6%, year after that 6%, year after that 5.5%. And then coming out of COVID, it's just had a big hockey stick up.
For it, yeah.
19%, 24%, 15%. So,
revenue and profit growth at the same time, and also debt free. So they're able to, I think, pretty high return on equity as well. So pretty efficient capital allocators.
Yeah, more than $1 billion cash on their balance sheet.
Yeah.
No debt.
Yeah, no debt.
Respect.
Yeah.
All right. So
honestly, a company I'd never heard of. I know the brands.
Here's my question.
Yeah.
The shoe business is in a state of flux. Nike, they were a distributor. They sold through Foot Locker and Rebel Sport and everyone. Then they have their own flagship stores, but they also sell more online. And you have named yourself the retail whisperer for many years now.
Not true.
And you loved retail brands, particularly brands that were going from a bricks and mortar to e-commerce. They were changing their sales mix and selling more and more online, better margins online. So is that part of the thesis here? Have you applied your retail whisperer cap to the old Deckers Outdoor Decking Corporation?
That's a question I can't answer.
Okay.
Yeah, I don't know. I don't know what their mix is of online. I mean, you can buy a lot of these brands through many online distributors here in Australia. The Iconic, what other big distributors are there? I don't know if you can buy them on Amazon, to be honest, but a lot of those major e-commerce sort of distributors, you can buy these brands.
It's probably not the same though. Like if you're selling your shoes through the Iconic, your margin profile probably isn't a lot better. Yeah. It's really when you're selling direct to customers that your margins are better.
Let me see.
But anyway, it doesn't really matter. It's something for, if people want to run with this idea, that's something to research themselves.
Yes.
As we said, not financial advice.
Not financial advice. Yeah, look, it's on my watch list. I haven't bought it. I'm unlikely to buy it.
Well, great. Well, we just wasted 10 minutes, so let's move on.
Well, it's on the watch list. I think if you look at the share price, it's run pretty hard in the last, even year to date, it's up 27%. So it might be one of those ones where if you see that it comes off a bit, there might be an opportunity. But I think I need to do a bit more DD to feel confident that this is something that's going to go into the satellite portfolio. But nonetheless, it's on the watch list.
Nice. Interesting company. I'm glad you brought it towards us. I look forward to the next one.
Love it. All right, Ren, it is that time of the show. Let's go.
This is Hit My Portfolio. Hit My Portfolio.
Yes,
Awesome.
we are bringing back Pimp My Portfolio for the second time. We had so much fun doing it the first time. This is going to become a mainstay, I think, where we get an expert in the studio and someone from the Equity Mates community gives their portfolio just at a high level to the expert, and then the expert has a look and gives some general feedback. And the expert that is joining us again in the studio, Luke Larrative from Seneca Financial. Luke, good to have you back.
Ren, Bryce.
Luke, how are you? And we can welcome to Equity Mates Investing, Maddy. Maddy, welcome to the show.
Hi, everyone.
Thank you for submitting to Pimp My Portfolio. We put the call out without anyone knowing what this segment was, and you put forward your portfolio. So we're really excited and also appreciative of you doing it. Now, as always, Ren, let's just give a very high level on how we see Maddy's portfolio for everyone listening.
Yeah, so Maddy's portfolio is split into ETFs and some individual stocks. About 80% of her portfolio is in broad-based market ETFs, the S&P 500, the Aussie ASX 200, and some other ETFs. And then about 20% is in some stocks, Apple, PayPal, Qantas, Soul Patts, and Xero. So, Luke, where do you want to start?
What's the name?
The name is KISS, which is like, keep it simple. I won't say stupid.
You can say stupid.
And I think, that's kind of the overall thinking of this. I feel like looking at this, it's sort of like I started off doing one thing and then I've kind of added to it, thinking that adding complexity is going to add performance or is going to be better because I heard about this or I want to do that or someone told me that dividend yields are good or whatever. And then it's probably detracting from returns and more importantly, like detracting from life, you know, like stuff that you actually like doing.
Okay.
So that's probably my overall.
I think you might need to explain some of that.
Hang on. So should we get a reaction here?
Okay.
We've got KISS is the name of the portfolio. Keep it simple, stupid. Maddy, what do you think of that?
It's pretty accurate, to be honest. I wanted to keep it simple, easy, and low maintenance. So I think that's a pretty accurate way of describing the portfolio. I actually think I went the other way where I had it complicated and started off individual and went into the ETFs.
Nice. Cool. So you're keeping it simple.
You're making it simple.
Yeah.
I like it.
I'm deliberately making it simple.
Yeah. Well, I mean, I that resonates with me because I was the same. I started in individual stocks and then realized that there were these ETFs and realized the power of them. So I think your journey's been very similar to mine, Maddy. But Luke, I want to hear, you said it was detracting from Maddy's life.
I just know how shit my life is and how this is what I have to do all day. So no, I'm joking. But look, I do think that, this whole investing thing is really simple. Now we've got multi-asset ETFs available and, they're your high growth or your balanced conservative type ETFs, and you don't need to own anything. You can just buy one security. You can just reinvest in that security. All the asset allocation is done for you to that particular risk profile. All you've got to do is figure out which box you kind of want to live in. And if it's to generate the highest possible returns and you don't care about volatility, then it's high growth. And if it's something else, then it's something else. And that would even be a simpler version of this portfolio. And so, Maddy, you could just find the appropriate multi-asset risk profile kind of based ETF for you, and you could literally own nothing else. You could just do that. And then you wouldn't have to worry about, how much money should I put in high yield? How much money should I have in the US versus Australia? How much money should I have in, emerging markets or, small caps or whatever, which is sort of the parts of the market that aren't in your portfolio at the moment. And you also don't have to worry about what Xero's earnings are going to be next quarter or whether the Apple Vision Pro thing's going to be a hit or not. Or, do you know what I mean? You don't have to deal with all that stuff, read them. You can forget about it. You don't have to listen to a newspaper, read anything. It's all done for you. So, and it costs you, I don't know, what are those ETFs cost?
Not a lot.
A Vanguard diversified high growth would be probably less than 50 basis.
Yeah, I was going to say they're like 30 to 50 bips. So, that's what I'd be doing.
I have a question for you, Luke.
Give it to me, Maddy. This is my favourite bit.
Um, so some of those individual stocks haven't performed very well. Would you actually sell right now at a loss and just lump it into an ETF?
Yeah.
Or would you
Yeah.
wait it out a bit longer?
Well, like you need to kind of go into each individual company, but at the end of the day, I'm big on, particularly for someone who's like trying to get to a more simple, lower maintenance, want to get on with the hobbies and things that I like that aren't managing my portfolio, and just want to use this as a savings vehicle. Like, get to your ideal portfolio as quickly as possible within reason. You know, I think that just because you might have lost money on one of these holdings and you've made money on another one, doesn't mean that the one to sell is the one that's done badly. Maybe it's the one that's done well is now too expensive and you just don't realize it yet. So I think people get caught in this kind of sunk cost fallacy that, I haven't lost money, I'll sell it when I get back to making money in it. When reality is it doesn't matter what you make money in next, as long as the next one you don't lose money again. So I think that getting to your ideal situation is going to take all those decisions off you. You're probably going to feel a lot better about it when you don't have to look at those holdings in your portfolio anymore. You know you're in a diversified product. You can just get down to sort of trusting the process over a longer period of time, knowing that there's nothing that you can do beyond what you're already doing, and you're kind of finished, for lack of a better word. So I know it's hard and it feels like, that's, X dollars or whatever. Like, that's investing. The best investors in the world have, a 50% or under 50% win rate. So that means they make 2 bets and one goes wrong every single time. And that's the very best hedge fund managers on the planet. It's all about how much money you make and lose when you win and lose. So don't stress too much about it. Just move on, get to your ideal portfolio as quickly as you can. And then you kind of finished.
Cool, thanks.
Now, Luke, I want to take this another way because, you're saying simplify. And I, as I said, I had a similar investing journey to Maddy, starting with individual stocks, then getting into ETFs. But what if, I'm speaking personally, but perhaps Maddy feels the same. Maybe she doesn't want to simplify to the nth degree and she wants to have some exposure to individual stocks. How would you approach constructing a portfolio that has all the elements that you're talking about, broad-based market exposure, some of those funds, but also gives Maddy some money to invest if she wants to have some exposure to some companies she thinks is interesting? Yeah,
I think investing is really, like in individual companies, is a really good way to learn about like how the world works, how businesses work, how you kind of react to different challenges and stresses and stuff like that. So I think it's really valuable. I reckon I've learnt most of the things that I know from investing in individual companies. So not saying don't do it at all. If the goal is to simplify, obviously there is a really simple way to do that. If it's not, or it's to some sort of blended version, the best thing about shares is you can say, okay, well, I'm going to take 70 or 50 or 20 or 80% of my money, and that's going to be in one of these, multi-asset, risk profiled kind of ETFs. And then I'm going to take whatever the balance is, and I'm going to make reasonable sized bets in 5 companies at 4% each. I'm just going to pull a number out of my, so then you're going to have, you're going to be able to spend your time looking at those companies, understand the earnings, understand the business drivers, understand the valuation, and having a really, deep knowledge of something. And that is a way where you can actually, as an investor at home, working 2 hours a day on it, start to develop an edge over the market over time. If these companies, Xero, Apple, Qantas and PayPal, are pet companies for you and you love those businesses and you love what they're doing and blah, 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 cool. I wouldn't choose necessarily those myself. I think some of them are pretty boring. But PayPal's like a toll road on your bank account. Like, it's pretty boring.
But like, boring companies can be great investments.
They can be. But they're not very fun.
Apple's done pretty well.
What do you reckon, Maddy? Do you reckon they're boring?
No, I don't think they're boring. I think there's a bit of tech, a bit of travel. I think it's they're pretty well-known brands, to be honest.
I don't know.
Xero's been one of the best stories on the ASX.
Don't love it. Don't love it at these prices, to be honest.
Fair enough. Well, hey, you know what? Good minds can disagree. So I guess, Maddy, do you have any
others are right.
Do you have any other questions for Luke?
Would you add anything? rather than subtract? Like, is there anything that you think you would add to this?
Look, I would choose, if I was going to buy like what Ren's talking about with, say, like, 70 or 80% of your money in a core strategy and then some stuff in the satellite, I would choose companies that are a bit smaller. That would be my preference. I think, companies go through a maturation cycle and there's a bit of a phase in the growth curve where those businesses can grow quite quickly and they often re-rate in a valuation sense as well because they're improving quality, whether that's paying down debt or just generating, more consistent, reliable earnings. So, you want to be investing in, if you're going to take precious money and put it into businesses, a few select businesses that you understand really well, try and find those kind of companies. They're generally on the ASX, like in that sort of a 200 to 2 billion kind of market cap zone where they might be like making revenues but like on the way to profitability or just ticked over into profitability or had 2 years of solid profit growth and they've got good operating leverage. So, Apple, they're great businesses, zero success story. It's great telling people that you own those shares, but they're kind of mature companies. And the irony of investing in mature companies when they're on a growth multiple is you're normally investing in a business that has to do something riskier than what they've done to generate incrementally lower returns than what they've done in the past.
Yeah.
Yeah.
Interesting.
And then I guess from an ETF point of view, just looking at that
Yep.
without going the other way and stripping it all back and just going your one multi-asset.
I don't know why you wouldn't do that though.
Is there anything outstanding?
Like, obviously emerging markets, small caps, like there's heaps. But the point is why would you make it hard? Like just, so, do the thing. Like you can just handball it to someone else and it's sorted and you can spend all your time trying to find 3, 4, 5 little companies that you're kind of, excited about.
Nice one.
There you go. Well, Maddy, some decisions there to think through. Either strip it all back and just go one multi-asset ETF, low cost that kind of gives you exposure to everything you've got there, plus a few of the things that we're missing in terms of small caps, emerging markets. And I think the other point that Luke made was don't get too emotional about. I guess it's more like an opportunity cost with the companies, the individual companies that are there. Even with those that are in profit, like if you think there's a better opportunity, then take it. Yeah. And I think that's what helps me when I look at companies in my portfolio that are down. I think Henry Jennings said there's just always another opportunity. And if you're just sitting it there for the purpose of it sitting there, like there's something else that it can go into that's definitely going to be a better result. So I hope that helps you think through.
Thanks so much, guys.
Thanks,
No worries.
Maddy.
Thank
Star.
you.
Thanks
Thank
for
you.
doing
Yeah.
this.
Appreciate you coming on, and we don't think your stocks are boring.
No.
So keep it up.
Thanks so much.
No worries, Maddy.
Thank you.
A massive thank you to Maddy. If you would like to book a time with Luke to review your portfolio, discuss the markets, or help you with your financial goals, head to equitymates.com/advice. Choose Luke's name and you'll get sent straight through to the booking form to find a time with Luke and the team. Luke, thank you again. Learning a lot.
Very enjoyable. Thanks, Maddy. Superstar.
All right, well, that is the second installment of Pimp My Portfolio. I think this is going to become a mainstay in the Equity Mates investing podcast feed. So make sure you keep listening. And if you want to submit your portfolio for Luke or another expert to take a look at, equitymates.com/contact is the place to go. We're going to take a quick break. And on the other side, we're going to have a look at 2 investor letters and what we've learnt from them. Welcome back to Equity Mates. Bryce, we're going to turn our attention to 2 investor letters. Now, for people who are new to the show or unfamiliar with investor letters, a lot of the big fund managers and hedge funds, especially in the US, actually a lot of the big and a lot of small fund managers, every quarter will write an investor letter, and those letters will be made public. And there's a really great subreddit, Security Analysis, that aggregates all the investor letters, or a heap of investor letters that you can go on and read. And we find investor letters a really great source of ideas for new stocks, but also just, I guess, assessments of where the market is, where it's going, how investors are feeling. There's always some good lessons around just how to be better investors. They're just a really valuable source of information, I find. Yeah.
Always have a little stock idea of some stocks that sometimes we've never heard of.
And so for this segment, we wanted to choose 2. from the opposite ends of the spectrum in terms of performance. Because you can certainly learn from those that have done very well and also those that perhaps haven't.
Yes.
So for this episode, the two funds we've chosen, Rowan Strait Capital, which returned 103% in 2023.
Yeah.
So they doubled their investors' money. And then Ace River Capital, which was down 29%.
Ouch.
So lost almost a third of their investors' money. Now, we'll include both of these links in the show notes. We'll also include a link to Security Analysis, their post where they've aggregated the most recent quarter's letters. So if you want to read these letters and read plenty more letters, head to the show notes. But Bryce, let's start with the positive news.
Yes.
Let's start with Rowan Strait Capital. Overall takeaways, what did you think? What did you learn?
Well, I mean, the big takeaway you've already said is that they doubled investors' money in 2023. Gotta love that. Not a bad result. Outperforming the market. I think the S&P last year returned about 24%, so 5 times the market return. So they gave a bit of a breakdown on what the biggest contributors to that result were, and there's some big names in here. Firstly, Meta was their best performing stock at 194%.
Yep.
Spotify, that was up 138% in the portfolio. Trade Desk, I'd forgotten about this stock, but I reckon 3 or 4 years ago, we had expert after expert in the small cap space come on and talk about it. It was up 60%.
Yeah.
And Shopify up 124%. So no wonder the fund overall returned over 100% when you've got at least 3 companies there all contributing upwards of 120% return for the year.
But I think there's a really important caveat here. So those 4 stocks were 4 of their top 5 largest holdings. And as you said, they all did incredibly well in 2023. But here's how they went in 2022. Meta down 64%, Spotify down 66%, the Trade Desk down 51%, Shopify down 75%. So it's a real, swings and roundabouts story. Like they got smashed in 2022, but they recovered and then some in 2023.
Yeah. Well, not only, and I think this is one of the big takeaways that I got from this. It was a lot about their emotional state of investing, and their point here was that they stayed invested in these companies through those massive drawdowns and subsequently were able to reap the rewards the following year. They avoided trading based on the macro, I guess, not trends, but the fears that were going on at the time, and certainly, stayed invested in those companies. They go on to talk a lot about the importance, very Buffett-like, very importance of patience, being selective.
Very Buffett-like in their temperament, not in their stock selection.
Yeah. Not swinging the bat at everything essentially, and just being very selective with what you invest in. But then once you're invested, staying invested.
Yeah. It's a really good lesson. Now, they speak about a particular stock in here. They added 1 position to their portfolio in 2023. I think there's also a lesson there in just how often the best investors add positions to their portfolio. And I reflect on how often I add positions to my portfolio, and it's certainly more than 1 a year. But like that, having that level of confidence and knowledge about a company and then putting in your portfolio is impressive. The company they added was Aiden, Ayden. The ticker is ADYEY. It's traded over in Europe. It's a payments company.
Payments processing. I think it's in the Netherlands or something.
Yeah,
it's Dutch.
Yeah.
So it's a payments processing company. They bought it at 22 billion euro valuation after the stock had dropped 75%.
Love that.
You love that. And they expect this stock to grow at a compound rate of over 20% in both its payment volume and revenue over the next 5 years.
Fascinating company. It's worth reading the write-up. The temperament of the founders of this company is also impressive. They didn't get caught up in the hype of 2020 and 2021. And while everyone was having redundancies in sort of 22 and 23, they actually added 53% to their headcount. They were just like opportunistic and just picked up all the best people.
Yeah.
So really interesting company, one that I'll certainly add to the watch list. But Bryce, I think let's turn to the negative. Let's turn to Ace River Capital, which was down 29% in 2023.
Not good, not good. It's a portfolio that is massively concentrated.
Yeah, crazily so.
Massively concentrated.
So in his letter, he wrote that he has 5 small or micro caps long and then 1 short, normally a large cap.
Yeah.
And I think that's incredibly risky portfolio construction. Both how concentrated it is, but also the short seems to add a lot of risk. I would like to see some portfolio construction experts talking about that. Maybe Luke does a Pimp My Portfolio on this construction.
On the short, yeah.
Because it just feels like, it feels like that shorting one large cap, especially in today's market, but just generally, I feel like you're getting enough sort of alpha from the 5 small caps. Like if you nail those, you're going to get differentiated returns.
Yeah.
Anyway,
so in terms of his largest position, it's Rick Hospitality or RC. Sorry, the ticker is Rick. The company RCI Hospitality. We have had someone on the show pitch this before. It's an adult entertainment operator, or one of the largest adult entertainment operators in the US.
Yeah, I think the largest in the US.
Yeah.
We had Yaron Neymark pitch it back in June 2020.
Yeah.
So a little while ago. We'll include the link to that episode in the show notes for this episode if you want to go back and listen to it. But yeah, it's the largest adult entertainment operator in the US. They own a lot of strip clubs, basically. And as this letter writes, because local governments aren't granting licenses for new strip clubs, these clubs are essentially local monopolies.
Yeah.
They also have a sort of like Hooters-esque restaurant franchise called Bombshells that they're trying to roll out across America. It seems this company is a real favorite of like the small fund, small cap investors over in the US.
Big time. It's run pretty hard since it was pitched back in 2020.
Has it?
Yeah. But anyway, he also discusses a new stock, Vox Royalties, which is essentially a company that plays in mining royalties.
Yeah, so they pay upfront cash, like a lump sum cash, and then they get a royalty from miners based on, the amount of profit they make or the amount of ore they dig up. And so they're essentially trading upfront capital for a long-term revenue stream.
Yeah.
There's a company in Australia that does something very similar, Deterra Royalties. The ASX ticker is DRR. If you want to have a look at that company, I think we've heard that pitched a few times. Maybe not on this podcast, but yeah, it's a really interesting business model where it's about finding the right projects.
Yeah.
That's probably where the rubber hits the road. But if you do find the right projects, you can have these like long-term annuity-like income streams that just pay year after year, and hopefully as these mines become more profitable, grow year after year.
So that's 2 investor letters, one from Rowan Street and the other from Ace River. We'll include both in the show notes if you want a little bit more detail on both of the stocks that we've discussed there, Aiden and Vox Royalties. But Ran, that brings us to the end of our episode today. If you'd like to join the conversation, hit us up in our Facebook. Come and join us in the Facebook community. Otherwise, if you want to submit a book for book club, if you want to submit your portfolio for Pimp My Portfolio, if you have any money-related question, or if you'd like us to connect you with an advisor, then please, we have a form, equitymates.com/contact.
Jeez.
All the information will be there.
It's got to be a long form.
You can choose what parts you want to fill out.
All right. Well, we will be back in your feed tomorrow with an Ask an Advisor episode. We're going to be speaking to Phil Thompson all about insurance, the insurances you need, the ones you don't need, and whether you buy it in super, out of super, pros and cons. So a big insurance bonanza. And then we'll be back on Thursday as well to keep covering off what's going on in markets.
Love it. We'll speak to you tomorrow.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.